Hello everyone, welcome back to our channel. This is Vaibhav Bansal. Today we are going to resume our direct taxation exemption series in English. Since last few days, no videos was coming for the DT exemption series for the English. So many of you are asking about that. So I was busy in the DT exemption series in Hindi. After completing that batch, I am resuming that your batch for the English. Now we are aiming to complete this batch latest by 20th of September, so that you can easily study for your examinations in the November 24. Before resuming, I just want to make a small announcement that we have already launched the test series. We have already launched the test series that you have already enrolled. Now the enrollment for the test series is already closed. Today is the date when our test series is going to start. This is the latest thing which we have enrolled for. This is the DT 10-day challenge. If you want to complete your direct taxation examinations, direct taxation syllabus within just 10 days, then this batch is for you only. Where we will give you a daily basis target in the morning. In the afternoon, we'll take the updates regarding that. And in the evening, we'll also give you some questions regarding your target that was given in the morning, so that you can assess yourself where you are lacking. The questions which we have sent to you, which will give to you, will also be evaluated and doubts will also be solved. Then we will also give you the most important question list for the November 24 examinations, which will comprises of 40 to 50 questions. That will be the most important questions for your November 24 examinations. That is, and then the bonus feature is in this, that you will also get your ICI mock test series first series. ICI mock test 1 series will be free of cost evaluated to you. Free of cost, that will be evaluated to you. You will be transferred to a separate private channel where you can ask me doubts and where I will share all the updates regarding the batch. Okay, the two batches were there. The first batch is already started from the 3rd of September. Now the next batch is going to start from the 15th of September to the 24th of September. So this is the opportunity that you can enroll in and complete your whole syllabus in just 10 days only. This is only to the minimum cost of 369, so that only the students who are serious about this can only join. Is this clear? So this is the point I made. No, I just want to make it clear that this is our DT 10-day challenge series. If you want that, you can enroll by the link given in the description box. There is a Google form. The link is given in the description box. You can enroll it from there only. Okay, this is all. After that, you will also get the link of the Telegram channel within a few days. Okay, this is all the announcement from what I have to make. Now we are moving towards our chapter, the transfer pricing chapter. Today we are going to start with our transfer pricing chapter. See, before starting the transfer pricing chapter, I just want to make it clear what is transfer pricing. First, we will understand what is transfer pricing, then we will move forward towards the concepts. So I'm coming to my board notes which I have written for the Hindi batch students. I will share these board notes in my Telegram channel, but it is suggested that you should also write these notes in your handwriting in your notebook. That will help you to retain more. You can pause the video, you can write this as many times as you want so that it retains to your mind. Okay, now coming to the point, what is the concept of a transfer pricing? What is actually transfer pricing is? For that we have taken two cases, case number 1 and the case number 2. Okay, now what is case number 1? Suppose there is a VV Limited, Vaibhav Bansal Limited in India, and there is a Bansal Limited in Maldives. Okay, there are two companies which are related to each other. What does it means? What is related? We will see under this chapter, under this chapter only under section number 92C. 92C gives the definition of associated enterprises. So what are these associated enterprises? We'll going to see in this lecture only. Okay, now what is the case? Case 1 is suppose the cost of the Weber Bansal Limited is selling something to the Bansal Limited for 200 CR. Okay, the actual cost to VV Limited, the actual cost to VV Limited is only 50 CR for that product which he is selling at 200 CR. Okay, now if it shows, the actual cost is 50 CR only, so he is making a profit of 150 CR. On that profit, he has to give at the tax at the rate of 30%. Yes or not? Yes. No. What it says? It says let's increase our cost to 150 CR. Not take, let's say not take 50 CR, let's increase our cost to 150 CR. We are increasing our cost to 150 CR. Is this point clear? Now, if we are increasing our cost to 150 CR, then what will happen? 200 CR is the sale price, 150 is the cost price, so our profit is 50 CR. What we are getting, we have to give tax at the rate of 30% of the 50 CR, but earlier we have to give tax of on 150 CR at the rate of 30%. So we saved 100 CR multiplied by 30% is equal to 30 CR for our tax expenses. This is where the government find that it is the tax revenue loss. So they just came up with a transfer pricing. They just came up with a transfer pricing concept. Now, this is the another point. What is this another point is? See, case number two. VV Limited cost is 50 CR. Earlier they were increasing the cost. Now what will they do? They will decrease their sale price. Say VV Limited was earlier selling it to 200 CR, but now selling it to only 60 CRs. So they have decreased their price. So earlier, what was the profit? Earlier profit was 150 CR. That is 200 CR minus 50 CR. So they were getting the 150 CR profit on which they have to give tax at the rate of 30%. So they had the tax, they had the excess tax to be payable. But by this arrangement, what they have said, our sale price is only 60 CR and our cost price is only 50 CR. So now the profit only is 10 CR multiplied by 30%. Now the tax expenditure is only 3 CR. This is how the company plan their taxes. This is how the company can plan their taxes with their associated enterprises, with their related party enterprises. So the government has given a exhaustive definition or the inclusive definition for the under the 92C, where they have given the definition of associated enterprises to whom the government is going to assume that it is your related person, it is your associated enterprises. Is this point clear? This is the whole concept of the transfer pricing. So, what it says, see, computation of income from international taxation having international transaction having this regard. So, what it says, whether it is income, whether it is interest or other expenditure, or whether it is allocation of any expenditure, there might be a chances that you have performed any certain activities in a joint venture. So if you have performed any other activity in the joint venture, so you have to apportion that revenue, you have to apportion that cost expenses to both the parties whoever entered into a joint venture. So if there is any allocation of expenses, any joint activity in relation to any joint activity, all these need to be done at the arm's length price. What government is saying, whether it is expenditure, whether it is income, whether it is any allocation, all these needs to be done at the arm's length price. Now what is arm's length price? The government said arm's length price is just a correct market price, whatever is the market price to the unrelated person. Like suppose I am VV Limited, Vaibhav Bansal Limited. Is this clear? Now Vaibhav is my relative. Suppose Vaibhav is my relative. Now there is another person named Sundar. He is not related to me. I do not know him. I do not know Sundar, who he is. So I am selling something to Sundar at the rate of 200 rupees. At the rate of 200 rupees. So what the government is saying, if you are selling anything to an unrelated person at rupees 200, then the correct market price or the arm's length price for selling the goods to whoever is also rupees 200. is also rupees 200. If you are reducing the revenue or increasing the cost in this particular transaction with your related person, then what we will assume? We will assume that you have transferred your price, just because you want to give less tax in India. So this is the provision what government came up with. What it says, ALP means the price which is used in transaction with non-associated enterprises like the unrelated person plus in uncontrolled conditions. What is the uncontrolled condition that we'll see under after on in this chapter only, in the upcoming part of the chapter. In simple word, ALP is the correct market price. What it says, ALP is the correct market price. Whatever is the market price which you are giving to your unrelated person, the same market price, the transaction should be done at the same market price which you have done with your unrelated person. Is this point clear? This is the only thing which I want to explain, or nothing else in this. It is just as simple as that. You need to remember that? No, you do not need to remember this on this section 92. It is the conceptual section that you need to understand why this whole provision of transfer pricing came into picture. Exceptions to 92. What it says, income, expenditure, allocation, everything is covered here. But the government does not want to reduce their tax revenue. The government does not want to reduce their tax revenue. So what it says, if applying the by applying the transfer pricing provision, what government says, listen very carefully. By applying the transfer pricing provisions, if your income decreases, or your loss increases, in either of the cases the government is going to lose their revenue. Either the income decreases or the loss increases. In that particular cases, transfer pricing concept or transfer pricing chapter is not going to be applicable. The transfer pricing is not going to applicable in this particular case. This is the exception to section 92. What government says, it's just to protect their tax revenue. This is the whole agenda for the exception to section number 92. See what it says. If adoption of the aforesaid income, interest, or other expenses, allocated expenses at arm's length price, whatever said to the under the section number 92, if it has the effect of reduction of income by applying the transfer pricing provisions, there is a reduction of income or there is an increase of your loss, there is an increment of the loss, then the transfer pricing provision shall not apply. The transfer pricing provisions shall not apply. This is section number 92, the exception to section 92. This is clear. Now we are coming to the most important part of this chapter, that is the meaning of associated enterprises. Earlier I said it is like of a related person, it is a related party. Now we'll go in detail what is associated enterprises is. The government has given the few certain criterias till M. What the last point is either very easy, like there exists between two enterprises any relationship of mutual interest as may be prescribed. So the government has given the scope to increase the list in section 92, 92A. Sorry, if I have said 92C, it is 92A. Is this point clear? So this is the scope where the CBDT or the government may prescribe more combinations in the list of these in the list of associated enterprises. So we are starting associated enterprises point by point, and for that we have also completed each point chart. For that you will be able to complete very easily. This is the only chart when will you see in at the at your 1.5 days revision time of your examinations. You will go through it once and you will understand each and every concept. So this needs also be made by you. I will provide it, but please, it's a request, make it by your own, make it in your own handwriting. That will help you to retain better. Okay, now coming to the point. First point, enterprises holds directly or indirectly shares at least 26% of the voting power in other enterprises. What it says, if any enterprises is holding at least, what it says, at least, so at the at 26%, is this associated enterprises? 100%. At 26% also it becomes the associated enterprises, because the word is at least, minimum 26 should be there. So if 26 is there, then it is a associated enterprises. Do not check for 26 or more, 26 more. Okay, so what it says, one enterprises hold directly or indirectly shares carrying at least 26% of the voting power in other enterprises. So see what it says. There is a enterprises called VV Limited, and there is an enterprises called Bansal UK. Is this clear? VV Limited and Bansal UK. See, VV Limited is holding in Bansal UK 26% of a voting power. What is holding? 26% of the voting power. Is 26%, exact 26% can be can comprise of associated enterprises, can make it a associated enterprises? Yes, 100%. That we just cleared in the just cleared before. So what it says, if you are holding 26% of the voting power in other enterprises, then the both enterprises, VV Limited and the Bansal UK, will become a associated enterprises, and all the provisions of this chapter, all the provisions of the transfer pricing chapter will be applicable to VV Limited as well and the Bansal UK as well. Is this point clear? This is the first point. Now coming to the second point. Any person hold. Now first point, in the first point it is said one enterprise, means it is an enterprise, it is a body corporate. Now what it is, any person hold, any person under the income tax act, person, what means the person is, there is a seven kind of persons list is given in the income tax definition: individual, HUF, firm, AOP, BOI, AJP, judicial authority, local authority, and the companies, everything is covered there. So any person holds directly or indirectly shares carrying at least 26% of the voting power in each of such enterprises, means a person is holding 26% of the voting power in two enterprises, then these two enterprises will become an associated enterprises. Is this point clear? Now what it says, see, VV Limited is a person. Is a person. He's a company. He can be a person. It can be a person. Okay. He's holding 26% of the voting power in Vaibhav PLC, and he's also holding 26% of the voting power in Bansal UK. Is this clear? If he is holding 26% of the voting power, then VV Limited and the Bansal PLC already becomes the associated enterprises in virtue of point number one. Correct? Now, if VV Limited and the Bansal UK, VV Limited is holding 26% of the voting power in Bansal UK, then it also becomes the AE because of the virtue of point number one. Now, if a person is becoming the associated enterprises of the two enterprises, both can be NR, both can be R, both anyone. So these will be the associated enterprises. Weber PLC and Bansal UK will also become the associated enterprises in this case. Is this point clear? Without having a direct relationship between the two, it is an indirect relationship. So what it says, directly or indirectly, there is an indirect relationship between the two companies. Is this point clear? Now, a loan advanced by one enterprises to another enterprises constitutes at least 51% of the book value of the total asset of the other enterprises. Come to the point. This is point number three. What it says, VV Limited, and there is a Weber PLC. VV Limited and a Weber PLC. Suppose Weber PLC has grant a loan. Weber PLC has a 10% voting power. 10% voting power only. What it says, it is only a 10% voting power. So with the 10% of the voting power, it will not become associated enterprises. To become associated enterprises, you need 26% of the voting power. So by virtue of this point, it is not a associated enterprises. But suppose VV Limited have the book value of the asset is rupees 100 CR. VV Limited, the book value of the VV Limited of their assets is 100 CR. Okay, and the Weber PLC has granted the loan to the VV Limited to for 53 CR. What Weber PLC did? Weber PLC give loan to the VV Limited for 53 CR rupees. Is this point clear? Now, 53 CR is 53% of the total book value of the assets of VV Limited. What it says? 53 CR is more than 51% of the total book value of their assets of VV Limited. It is greater than 51%. Yes, it is greater than 53%. So by virtue of the finance loan of 53 CR to the VV Limited, which is more than 51% of the total value book value of the assets, by virtue of this point, by virtue of point number 3, it become the associated enterprises. Is this point clear? This is the point number 3. Now, one enterprises guarantees at least 10% of the total borrowing of the other enterprises. If one enterprises guarantees at least 10% of the total borrowing of the other enterprises, then it will also become the associated enterprises. What it says? See, there is a VV Limited, again VV Limited, and the Bansal UK. Is this point clear? Now, what it says? Total borrowing of the VV Limited is 100 CR. Total borrowing of the VV Limited is 100 CR. Bansal UK give the bank guarantee of rupees 10 CR. What it says, the Bansal UK gives the bank guarantee of rupees 10 CR. 10 CR is 10% of 100 CR. So what it says, if you have guarantee at least 10% of the total borrowing of the other enterprises, then you both become the associated enterprises by virtue of point number 4. By virtue of point number 4, the VV Limited here and the Bansal UK will also become the associated enterprises, because the Bansal UK have guaranteed 10%, at least 10% of the total borrowing of the other enterprises, that is a VV Limited. Is this point also clear? Now, coming to the point number 5. More than half directors or members of the governing body, or at least one executive director or executive member of the governing body of one enterprise, is appointed by another enterprise. So what it says, if one enterprise is appointing more than half of the directors or members of the governing body, or at least one of the executive director or the executive member of the governing body, then the enterprise who is controlling these members of the other enterprise, these two enterprises will become what? Associated enterprises. Now let us show you what it says. It says that VV Limited or Weber PLC will become associated enterprises if more than half directors or one executive director or appoint one executive member of the governing body, if VV Limited is doing any of these work in the Weber PLC, then these VV Limited or Weber PLC will become what? Associated enterprises in virtue of point number 5. Do you need to remember these point number 1, 2, 3, 4, 5, or we can remember just the provisions, ignoring the point numbers? You can just remember the provisions. You just can easily forget these point numbers. They are not relevant at your point of time, at your examination level. Is this point also clear to you? Point number 5 is also clear. Now, more than half of the director or members, or at least one executive director or executive member of the governing body of each of the two enterprises. Now again, there is a two enterprises. A person is controlling all these things of two enterprises, then two enterprises will also become what? The associated enterprises. Now see what is happening. See, VV Limited, and there is again we have a PLC and Bansal UK. If VV Limited is controlling all these things for the Weber PLC and all these things as well for the Bansal UK, then Weber PLC and Bansal UK will also become what? Associated enterprises. Will also become what? Associated enterprises. I hope this point is also clear to you all. Now, what it says? Now, the manufacturing or otherwise business of one enterprise is wholly dependent. See what it says? That's wholly dependent in on any intangible of the other enterprises. Like one enterprises is wholly dependable on the intangibles of the other enterprises. Say suppose VV Limited has some license. Okay, license. It is their own license. VV Limited owns that license. Okay, it gives franchisee to Another, like suppose Vaibhav PLC, it gives franchisee to Vaibhav PLC on that license basis. If Vaibhav VV Limited, if VV Limited revoke that license from Vaibhav PLC, then Vaibhav PLC will not be able to operate in their field. They will not be able to operate. If this is the case, that someone is wholly dependent on any intangible of the other enterprises, then these two enterprises will also become what? Associated enterprises. I hope this point is also clear to you. Now, what it says, see, VV Limited and there is a Bansal UK. Okay, Bansal UK is wholly independent on the intangible provided by VV Limited. Whatever VV Limited is providing the intangible to the Bansal UK, if the Bansal UK is wholly dependent on the VV Limited, then the VV Limited and the Bansal UK will also become what? The associated enterprises. Is this point clear? Now, coming on to the next point. At least 90% of the required raw material and consumables of 1% are supplied by another enterprises. What it says? It says if if suppose one enterprises need 100 tons, if one enterprises need 100 tons of raw material for their manufacturing, what it needs? 100 ton of raw material. But out of that 100 ton, more than 90 tons, suppose 92 tons is coming from one enterprises only, is coming from one particular enterprises only, then there is a chance of influence. So here also the government says where there exists any chance of influence, then we will assume it is a associated enterprises, and the price and other condition relating thereto are influenced by such other enterprises. Okay, so what it says, suppose where we are on the point number 8. VV Limited and the Weber PLC. What it says, VV Limited and the Weber PLC. VV Limited is VV Limited is transferring 90% of the raw material or the consumable to Weber PLC. Okay, the total consumption is 100 CR. Suppose the total consumption, raw material consumption is of rupees 100 CR, and suppose VV Limited is giving that raw material worth rupees 90 CR to the Weber PLC. It is giving 90% to the, it is giving raw material 90% to the Weber PLC. Then these two become what? Associated enterprises. And listen to it very carefully. All the terms will be decided by VV Limited only. All the terms decided by the VV Limited only. Okay. Now, this provision is for only manufacturers and not traders. This need to be taken care of. This provision is only made for the manufacturers, not for the traders. Now, coming on to the next one. The goods manufactured by one enterprises are sold to another enterprises, and the price and other conditions relating thereto are influenced by such other enterprises. Who is the such other enterprises? To whom these goods are sold. Who are the purchaser of these goods? They are, that purchaser is influencing the price and the other conditions. Then it will be considered as a associated enterprises transaction. See, there's a VV Limited supplying goods, supplying goods to Weber PLC. Weber PLC is a buyer here. Here is a buyer who is paying the price. Who is paying the price? Okay. Sold the goods manufactured. VV Limited sold the goods manufactured to the Weber PLC, who is giving, who want to give, who have to give the price. So they want to reduce their price because they have to give tax. They have to suppose they want to reduce price as a manufacturer or as a businessman. I just want to reduce my price. Yes. So VV Limited is saying the terms of the contract on which you are transferring the goods manufactured, the terms and the price will be decided by me. There is a controlling power for the Weber PLC. If the Weber PLC is controlling the terms and the price under the agreement where the goods manufactured are sold to the other enterprises, then VV Limited and the Weber PLC will also become what? Will also becomes associated enterprises. Is this point clear? This is the point clear. Now, where one enterprise is controlled by an individual, the other enterprise is also controlled by such individual or his relative, or jointly by such individual and his relative. So what it says? Listen to it very carefully. Vaibhav controls 51%. Controls means 51%. The word is written as controlled. Point number J is controlled. Okay, so control comes with 51% of the voting power. So if it controls Weber PLC, if it controls what? Weber PLC, no. What it says, if you own 51% alone, then also you are in associated enterprises. But here what the catch is, you must be an individual. You must be an individual. What it says, any where any enterprise is controlled by an individual. The provision said by an individual. So you must be what? An individual. So Vaibhav is an individual. Okay. He controls, the Vaibhav controls controls Vaibhav PLC. Suppose buyers own by its relative, he is not owning any share, but his relative is owning 51% of the voting power, or 51% of the shares of the Weber PLC. So it controls through relative, or not him exclusively, but they are jointly controlling the Weber PLC. They are jointly controlling the joint old own and relative. If they jointly also controlling that other party, that is the Weber PLC, then these two, Weber and the Weber PLC, will also be called as the associated enterprises. What will be the called as associated enterprises? I hope this point is also clear to you. Now, it is point number 11. Point number 11 says, where one enterprise is controlled by a HUF, the other enterprise is also is controlled by a member of such HUF, or by relative of such HUF, or jointly by such member or his relative. So what it says, listen to it very carefully. Suppose VVHUF is a HUF. Okay, it controls Weber PLC. Means 51% of the shares it's holding what? Who is holding? VVHUF is holding under Weber PLC. Is this point clear? So Weber VVHUF is controlling Weber PLC. Suppose the VVHUF, there is a member called Vaibhav. Vaibhav is the member of the VVHUF. He is also controlling Bansal UK. Another enterprises, he is controlling the Bansal UK. So these two enterprises, Weber PLC and the Bansal UK, will also become what? Associated enterprises. Is associated enterprises. Can it hold by Weber Limited? Weber can hold by its own through its relative, or jointly. Any combination can happen here. Is this point clear? This is the only point which you need to remember. Now, coming on to the last point, where one enterprise is a firm, associated of persons, or body of individuals. If one enterprise is these three kind of a persons, only these three, not everyone, not a company, not AJP, it's only AOP, BOI, and a firm. The other enterprises hold at least 10% interest in such firm, associated of persons, or a body of individuals. What it says, other enterprises. Here should be a company. Enterprise means a company, body corporate. So if there is a body corporate which is holding at least 10% of interest in either firm, association of person, or the body of individuals, then it will be called as a associated enterprises. So what it says, see, there is a Weber PLC. It is an enterprise. Okay, it is an enterprise. What is doing? VV Associates, VV AOP, VV ABOI. This type of a firm, AOP, BOI. If it is holding 10% of interest here, 10% of interest here, 10% of interest here, they become AE. Here, they become AE. They all become what? AE. They all become AE. Is this point clear? I hope this point is very much clear to you all. Is this point clear? This is here we complete our definition of meaning of associated enterprises. Now we are moving towards what is an international transaction, because the transfer pricing is applicable on the international transaction and some of the specified domestic transaction, and few domestic transactions are specified by the government. In that case also the transfer pricing provisions will be applicable, but Majorly, the transfer pricing is applicable on the international transaction. So where we have started with the transfer pricing chapter, we have written international transactions or specified domestic transaction, means some of the domestic transaction that will be specified by the government. On that also the transfer pricing provisions will apply. Is this point clear? Now we are going to start with the international transaction meaning. What does international transaction means under the section number 92? Is this point clear? Then we'll also come upon the deemed international transaction. What is the deemed international transaction? This is important. International transaction is not much important, but deemed international transaction important is. It is very much important that deemed international transaction need to be understood by you very much thoroughly. Okay, then we will study the deemed international. Sorry, we will study the specified domestic transaction later on. Later on we will study this because I have to link it with some safe harbor rules, etc., that will be of the later stage of your chapter. So we will complete the specified domestic transaction there only. Okay, so 92BA shall be on hold on this part. Then we will start with the computation of arm's length price. This is a very important topic, and major of the time the question will come only from this part. Okay, then the chapter will continue, and everything important in this chapter, nothing can be left apart. Nothing can be left apart. Every point, everything is important for an examination that can be tested in your examinations. Very much possible chances that everything can come in your examination. Nothing is not important in this chapter. So you need to understand this chapter very much thoroughly. So this is let's we will continue on the meaning of international transaction. Now coming forward, what is the meaning of the international transaction? So suppose what is an international transaction that we all know? International transaction means the transaction entered between two or more associated enterprises, between whom the associated enterprises, out of which at least one party must be a non-resident, then only it will become an international transaction. If both the parties are resident of India, then how will it become the international transaction? For becoming the international transaction, one must be a non-resident. So it says there's any transaction that enter between two or more enterprises, two or more associated enterprises, then the one party must be a non-resident. What it says, the one party must be a non-resident. And whatever the nature of the what should be the nature of this transaction? The nature of this transaction can be either purchase or sale, providing services, lending or borrowing money. We have seen the guarantee amount and the loan, the finances loan, everything is covered here. Lending or borrowing money, any other transaction having impact on income losses or assets, or any business restructuring or reorganization transaction, irrespective of its impact upon current or future income losses or assets. Is there any business restructuring, then also it will become a part of international transaction if it is done between two or more enterprises and one must be of non-resident. For this, you have already studied an internal reconstitution chapter in CA intermediate. CA intermediate, there was a chapter named internal constitution. This is what business restructuring is. Now, what international transaction includes? International transaction includes a mutual agreement. It includes a mutual agreement of allocating cost expenses in relation to the joint activity. I also said that there is a joint activity like a joint venture, etc., as carried out by MNC group enterprises. This will be very much clear in the method PSM, where we will study the profit split method. Then it will be easily understood by you what is trying to say here. Is this point clear? Now coming on to the point, what is the deemed international transaction? What is a transaction which we will deem it as an international transaction? Listen to it very carefully. There is a this is V. This is V. Associate as enterprise is V. You can assume yourself as a associate enterprises. There is a associated enterprises of V, of A Limited. There is a associated enterprises. A Limited associated enterprises is BINC. Is this point clear? Now, what it is done? Your associated enterprises, that is a BINC, has come up with an agreement with Mr. C, who is an unrelated person to you. Who is an unrelated person to you, that is the associated enterprises. He is the unrelated person. So if you are doing any international transaction with that unrelated person, if there is any international transaction with unrelated person, then you will not be covered under the provisions of the transfer pricing. Why? Because it says entered between two or more associated enterprises. If you are not associated enterprises, if you are a unrelated person and you are not associated enterprises, then the provisions of transfer pricing will be applicable or not? No, it won't be applicable. If it is not applicable, then there is any arrangement between the two will become unchecked, will go unchecked by the government. So government, what is saying? Government is saying that if there is a associated enterprises of the assessee enterprises and he is entering into an agreement with Mr. C, any unrelated person, and there is a prior agreement before before the transaction between the assessee enterprises and the Mr. C, there is a prior agreement or the substantial terms determined in that prior agreement between the unrelated person and the associated enterprises. The terms of this transaction, which needs to be done with the assessee enterprises, the term of this transaction is determined by whom? By the associated enterprises with the unrelated party prior prior to the transaction. What is this? Prior to the transaction. So the government think that this is not a usual transaction. This is the transaction where Mr. C is just a medium, so that he can transfer to Mr. C. Mr. C can transfer to to the associated enterprise, that is a BINC. So there is not a direct link between the two. So it will not cover under the transfer pricing provisions. It will not cover under the transfer pricing provision. So they can escape from the transfer pricing provision. So for that, the government is saying that we will deem that this transaction is also an international transaction, and if it is an international transaction, then you have to do it at ALP, arm's length price. You cannot reduce your sales price, or you cannot increase your cost. This is what the government is saying. So see what government is saying: a transaction of an assessee enterprises with the unrelated person, whether resident or not non-resident, will be deemed to be an associated enterprises. It will be deemed to be an associated enterprises if in relation to that relevant transaction, the prior agreement between such unrelated person and the associated enterprises, in between the two there is a prior agreement, the terms are substantially determined between such unrelated person and the associated enterprises, and there is a some substantial terms of that transaction, if of that contract is already determined by the associated enterprises and the unrelated person, then it will be deemed to be an international transaction. I hope it is clear to you all. Now, as I said, it will be kept on hold. We will come on it later. We'll come on it later. Now, what is the computation of arm's length price? Now, whatever we have said, there is the associated enterprises. If it enters into an international transaction, that the transaction should be at arm's length price. Now the question is, what is the arm's length price? How we will calculate, how we will get to know it is the arm's length price, and at this transaction, at this point, we will transact with our company, with our associated person. So the government said we are giving the six type of methods. From these six type of methods, you have to compute your arm's length price. So I said, whether I have to apply this, whether I have to apply this, whether is this, or this, or all of these methods. So the government said, no, you have to apply any one method which is most appropriate to you, most appropriate method. Whatever the method is, must be most appropriate for your transaction. If the method is most appropriate for your transaction, that it will be considered as a most appropriate method, and you can compute with any of these methods. So the government is saying arm's length price in relation to the international transaction or the specified domestic transaction shall be determined by the most appropriate method, considering the nature of the transaction or the class of transaction or the associated enterprises or functions performed by such person or other relevant factors. So the government is saying check what is the most appropriate method. This can be checked through various methods, by what are the functions performed, what are the nature of transaction, what is your associated enterprises. The most appropriate method can vary from these factors as well. So if you have considered everything, for that, in practical life, you do FAR analysis. What you do? FAR analysis. What is FAR analysis? Is functions performed, assets involved, or the risk assets or risk associated. Functions performed, assets involved, and the risk associated. These are the three things which you need to check before coming to the conclusion. What is the method? What is the most appropriate method that you have to apply? Okay, these are the comparable uncontrolled price method, resale price method, cost plus method, PSM, that is a profit split method, TNMM, and thus any other method which may be prescribed by the government. Okay, in any of the above case, AO may, what it says, AO may AO on his discretion proceed to determine the arm's length price after giving a reasonable opportunity of being heard. So how he will give the reasonable opportunity? Through a show cause notice. He will send you first a show cause notice that show the cause why we will not proceed to determine your arm's length price. So show the cause. We are giving you a notice that show the cause why should we not proceed further for computation of your arm's length price. So it is done by a opportunity is given by a show cause notice. Is this also clear? So AO on his own discretion, if he finds that he need to interfere in that transaction, then he will interfere. Otherwise, he will not interfere. Okay. Now ALP shall be determined by the most appropriate method. Okay, which will be applied in the prescribed manner, that is in the rule 10b. The most appropriate method, the section 92C gives the list of these section names, but these sections, but how we will apply these sections, how we will compute the arm's length price under the comparable and control price method, how we will compute the arm's length price under the resale price method, or everything will be covered under rule number 10b. What is covered under rule number 10b? What it says: comparable uncontrolled price method for the cup method. Come here in the board notes. Yeah, what it says: comparable uncontrolled price method. Suppose there is a VV limit and there is a Vaibhav PLC. He sold goods. The VV Limited sold goods to the Vaibhav PLC of suppose of rupees 100. Okay, these are the associated enterprises. Yeah, correct. VV Limited is also selling the goods to some Tushar, unrelated person. Tushar and an unrelated person. Is this point clear? If the VV Limited is also selling goods to an AE and also selling goods to an unrelated person, then are the same goods, are under the same conditions? If everything is same, the FAR analysis is same, so the government is saying, so what the government is saying, just compare your transaction, just compare your AE transaction with this unrelated person transaction. Are you charging more or are you charging less? If there is any functional differences, if there is any FAR analysis differences, so just reduce that, just ignore that, just make that adjustment of these adjustment. Apart from these adjustment, what you will do, you will directly compute what, you will directly compute the arm's length price on the basis of the unrelated person. Whatever you are charging to the unrelated person must be charged to the Weber PLC as well. So from where we will start? We will start with the unrelated person. So what it says, see, when it will be regarded as the most appropriate method, when the cup method will be regarded as the most appropriate method, if details of the comparable transaction, here in the case of the Tushar, unrelated person, or prices etc are given, then we will apply what? Comparable and control price method. What is the method? identify the price charged or paid in the comparable uncontrolled price method. Uncontrolled means is where you cannot control the transaction, where you cannot determine the terms as per your choice. You have to be you have to listen to other person as well. You cannot control him. When you cannot control him, so you can also not control the transaction as well. So it is said the uncontrolled transaction. Okay, uncontrolled transaction. What is the price to the uncontrolled transaction? Suppose the transaction are done with Tushar, whatever the prices you should write here. Now adjust the differences. What I said, the functional differences, the FAR analysis which I have told you, you have to adjust those FAR analysis in your point. So adjust such price to account for difference between the international transaction or specified domestic transaction and the comparable uncontrolled transaction. This will also be understood with the help of a question. We will we will take that at the later stage of this chapter. Then we will come with the arm's length price. Now coming with the resale price method. What is the resale price method? Is resale price method is when you are purchasing something to a AE and selling something and selling the same goods to the unrelated person by not substantially changing it. By not substantially changing it. You should not substantially modify that product. You should just take it, you can just purchase it from the AE and sell it to the other non-resident. If this is the case, then you will say it is a resale. Resale, we purchased it and we sell it, we purchase it, we sell it. It is a resale method, so it is a resale price method. Is this point clear? If purchased goods or services from associated enterprises and resold to an unrelated person, then the resale price method will applicable. So from where we will start, we will start with the unrelated person only. We will start with the unrelated person only to identify the price charge against the resale goods to the unrelated person. What is the unrelated person? In our case, the Tushar is the unrelated person. Is this point clear? This is the point. Now, reduce the reduce the normal gross profit margin. What we need to reduce? Just mark it down. Gross profit margin. It is not a net profit margin. It is a gross profit margin. Okay. After the trading account, you will get the gross profit margin. So that we have to take. Why it is gross? Why it is gross? Because you are just a trader. Because you are just a trader. If you are just a trader, then you are just preparing a trading account. If you are preparing a trading account, so for trade account you will only get the gross profit. From the from the profit and loss account you will get the net profit. But you are a trader, so you have to take what? Gross profit margin. Is this point clear? Is this point clear? So okay, gross profit margin that we have to reduce it. Now reduce all expenses incurred by a assessee in relation to purchase. Okay, whatever the purchase cost, you have to reduce that. So reduce that cost also. Now adjust any differences. Whatever we have adjusted here as well. Point number two, we have to adjust here as well. But adjust such price to different. If there any difference, that is a functional difference, is there any, you have to reduce or add, whatever the case may be. If there is a case to add, then you have to add. If there is a case to reduce, then you have to reduce. After that you will come up with the arm's length price. Is this point clear? This is very easy. Clear. Now what is the cost plus method? See, what is the cost plus method? Cost plus method is we have some cost, we have to add profit on it, then we will sell it. This is the actual process. Whatever a manufacturer is first determine its whatever his cost is, then add some profit to it, and after that he's selling that product. So the difference between the cost and the cost and the sale price is the profit. So this is saying the same. If the details of the cost and profit markup are given, if the cost and the profit markup details are given, so you will apply the cup method. You will apply the CPM method, cost plus method. It is a CPM method. Okay. Now, how will you determine? How will you solve this question? So determine the direct and indirect cost of the transaction, because we have given the cost. So first we have to take the cost of what? Of whom? Of the uncontrolled transaction. So starting is with always be from the uncontrolled transaction. Is this point clear? So whatever the cost we are having, just take it here for the uncontrolled transaction. Just take it here for the uncontrolled transaction. Now we have to add, determine the normal gross profit markup. Again, here is a gross profit markup. Determine what the gross profit markup. And now this is the important step. Whatever we are doing, whatever we are adjusting on the basis of the FAR analysis is done along is done differently, is done separately, not from the gross profit margin. It is done separately. But when it comes to a cost plus method, then you have to adjust every differences in terms of the percentages in gross profit markup only. You have to adjust everything, adjust it, account for the differences between the said transactions, between the said transaction is between the AE and the and the unrelated person. If there is any transaction, if there is any difference in the functions, assets, and risk involved in both the transaction, that you have, then you have to adjust that from the normal profit markup only, and then increase the cost by such profit markup. And whatever the profit markup is, either you have to increase it or you have to reduce it. Just you have to check that, and you have to calculate the ALP. All these will be very much clear with the help of the questions. So you just need to understand whatever the process is. Now coming to the profit split method. So what is the profit split method is? So we have to understand with the help of an example. So what is the profit split method? Suppose there is a VV Limited. Is doing any project. He does not know what the cost would be. So he just joined three companies. He just said, it suppose it is a MNs residing in other country. He opted three companies. Okay, he opted what? Three companies. And said, you just perform this project on behalf of me. You all are expertise. You may be expertise of the construction, you may be expertise of the IT, you may be expertise of something. You just do this whole project on my behalf. Okay, this is the actual thing. Now, what it say? Weber PLC has actually incurred 500 CR as their cost. Bansal UK have incurred 600 CR as their cost, and the Sandhya ji have incurred what 900 CR as their cost. Now, the total revenue from this contract, the revenue that BV Limited is going to get for this contract is 5,000 CR. Is going to what? 5,000 CR. So now first we have to conclude what is the proportion. First we have to complete what is the proportion that on each company has contributed in that revenue. What is the proportion that each company has contributed? Then only we will distribute this revenue to these companies, the VVL, PLC, Weber UK, and the Sandhya ji. So first we have to check what is the actual contribution to these companies. So it incurred 500 CR cost out of the 200 CR cost. 569. The 200 CR cost, out of these 200 CR, 2000 CR cost, 500 is allocated to Weber PLC. So you will find a proportion here. Then again for the VVUA, you will find a proportion here. For Sandhya ji, you will find a proportion here. You will find the proportion of the cost. Now, on that basis, on the proportion of the cost, you will allocate what? You will allocate the revenue. Now now the 500 CR revenue will be allocated to whom? To all these three companies, but on the basis of what? On the basis of the proportion of their cost that we have concluded here. So what is the proportion? 500 into divided by CR, 600 divided by CR, or 900 divided by CR will be multiplied by 500, so that we will get what? We will get the revenue. We will get what? The revenue that each company is earning from this project. Is this point clear? This is the whole project. Now see, determine the combined net profit. That is the total consideration received less total cost. Okay, this is the first point. Allocate such profit. Now allocate such profit that we have just done with the revenue. You have to do what? With the cost. You have to just allocate such profit along with all the associated enterprises on the basis of their performed functions, asset, and risk. This is the FAR analysis. On the basis of that, you will what you will do? You will just simply allocate their profit to these three companies. Now, ALP of such assessee of the associated enterprises, that is, what is the ALP? ALP must be the cost incurred by you plus the allocated net margin, allocated profit. The cost plus the allocated net margin will give you the ALP of this condition. There is not so much of questions available for the PSM. There are not much questions are available for PSM as a practical part, so you can just read it and move forward. If there is any question, I will let you know and I will let you solve this question as well. Now coming with the transactional net margin method. What is the transactional net margin method? When details of net margin, whatever what we are saying, the net margin on above C, we are seeing the gross profit margin. Here we are seeing the normal gross profit margin. Now when the TNMM applies, TNMM applies when the net margin of the comparable uncontrolled transactions are given. When the net margin is given, we will apply what? We will apply the transactional net margin method. What the name also suggests, net margin. Net also suggests net margin. This is called TNMM. In short, TNMM. Okay, this is the point. What is the manner of the steps of application of this method is given in the rule 10BA. Now, what it says, identify the net margin realized in the comparable uncontrolled transaction, that we all know that we have to start with the uncontrolled transaction method. Okay, now adjust all the things, all the differences, and from the net margin, whatever we have done here, we have done in the CPM as well. Same thing. The under CPM, you are reducing all the functions, assets, and risk transaction, the functional differences from the normal gross profit margin. Here, you will reduce everything. You will adjust everything. The FAR analysis, you will adjust everything from the net margin. It says adjust such net margin to the account of the differences between the international transaction and the comparable uncontrolled transaction. Then such adjusted net margin method will be treated as ALP. Whatever the net margin method is, whatever point number 2 is, will be considered as an ALP in terms of a net margin. Then you have to apply on the figures that is given to you. Then it will come to the final amount, that is the that will be amount as a ALP, arm's length price. Now coming to the last point of this session, we are coming with the last point of this session, that is the other method. Any other method as may be prescribed by the government of India. If any method is prescribed, no method is prescribed as yet, so you can leave that. Consider the price which have charged or paid, would have been charged or paid, whatever the charge you have paid, or whatever the price you have paid, or whatever you want to pay, or whatever you would have paid to that transaction for the same or the similar uncontrolled transaction with or between the non-associated enterprises. Whatever the price you pay for the non-associated enterprises, that will become itself the arm's length price for the associated enterprises as well. So whatever the basic concept of the transfer pricing is, they are saying the same. What is they saying the same? You must be doing the transaction at the arm's length price. And what is the arm's length price? Whatever the price you are charging for the non-associated enterprises under the similar uncontrolled transaction. Under the similar uncontrolled transaction, whatever the price you are charging for the non-associated enterprises will be considered as the arm's length price. So this is what it says. So it is no rule as of now as specified by the board, so you can escape that. These are the 5 methods from which as well CPM and cup method are the most important, and few questions can be find for the RPM as well. But the most important point is this, and the point number 1 and the point number 3. Is this point clear? This is all for our session today. We will continue the chapter tomorrow as well. So we will complete the chapter in 2 or 3 days, maximum 3 days. Otherwise, we will complete the chapter in 2 days only. Is this point clear? So this is all for the session. I hope this session is very much useful to you all, and we will now continue as regularly as possible. Okay. Now, if you or your friend is anyone just won the DT exemption DT 10 days challenge series, so they can enroll. The link will be given in the description box as well. Hope you will find this session useful. You'll find this session insightful, and you will share your feedbacks in our comment box. The comment box is all yours. You can share all your feedbacks in the comment box. Whatever your honest feedbacks are, we are open to all feedbacks. Thank you so much.